Hey guys, Grant here. Yesterday we covered the accounting equation and its fundamentals. Today we're going to cover how the accounting equation works in the real world. Let's get into it. So in the last video, we broke down why assets must equal liabilities plus equity, and today we're going to cover how this actually works in the real world. Companies are always buying things, selling things, borrowing money, and you need to understand how these transactions impact the accounting equation. So before we get too deep into this video, let's put in place a formal definition of a transaction. For the purposes of this video, a transaction will be defined as any event that has a measurable effect on a company's financial position. And to be more specific, when I say a company's financial position, to tie this to an actual financial statement, the balance sheet, which represents a snapshot of the business's financial position, is going to show you a company's assets, liabilities, and equity, okay? And when I say a snapshot, I mean it's not going to be over a period of time, which is what the income statement shows you. It's going to show you in this exact moment, this is where the company is financially as it relates to assets and claims on these assets, okay? So if a company receives cash, borrows money, makes an investment, buys equipment, literally any kind of transaction that a company can enter into is going to impact this system here. That's why it's so fundamental. So the main point that I want you to take away from this video is the fact that every single transaction that a business can participate in is going to impact this equation. And to take this a level deeper, it's going to be recorded in such a way that the equation is going to remain in balance. Assets, as I always say, must always equal claims on assets, okay? Claims from external parties and claims from owners. Okay, so now we have defined exactly what a transaction is, and we have established the fact that every single transaction that flows through a business is going to be recorded in such a way that it maintains this identity here, okay? Assets equal liabilities plus equity. Most transactions can be understood through a few core patterns, and I'm going to walk you through them briefly. The first transaction that I want you to understand here today is one where value is simply moved within assets, okay? So this one is actually quite interesting. So let's say a company, let me move this real quick for you guys. Let's say a company happened to purchase some equipment, okay? We're dealing with a manufacturing company and they bought a conveyor belt, okay? So an equipment purchase is going to be considered an asset purchase, okay? This is a capital asset, meaning they're going to use this device or whatever they happen to buy to produce value for the enterprise, okay? That was their intention. So let's assume that the company used cash to make this purchase. Okay, so cash is sitting on their balance sheet. Cash is an asset, and they're going to use this resource to buy another resource. Okay, that's how it works. So cash is going to go down. Okay, they're going to use this cash to buy this equipment, and equipment is going to go up. So we basically used an asset to purchase another asset. Okay, we took cash and we used that cash to buy equipment. And the main thing I want to note here is the fact that assets are only going to be affected by this specific transaction. There's no debt being taken on, and equity is going to remain unaffected. So this is a specific kind of transaction where value is just going to move within the asset section of our balance sheet. Nothing else is going to be affected. In this second example, let's assume that the company took on debt to buy this equipment, okay? So they're going to go to the bank and they're going to get cash, but this is not their cash, okay? They're borrowing this cash. But since they received cash from the bank, we're going to record that as an asset, okay? So cash goes up. But since the company borrowed this money, we need to, of course, pay that back at some point in the future, and we need to recognize that fact on our balance sheet, okay? So we need to record a corresponding liability. Now, notice something here. Cash increased by whatever amount the company happened to borrow, and liabilities increased by the same amount. The equation remains in balance. The same thing is going to occur if the owner invests money into the business, but it's going to be slightly different. This transaction is going to impact equity. Okay, so let's say the owner invests money into the business as seed capital or something like that. So cash, of course, is going to increase. And then equity is going to increase, okay, because the business owner is investing their own money into the business, okay? But notice the balance. That's it, guys. Thanks for tuning in. Like, subscribe, stay tuned. Thanks.